So hi, today Nick and I are going to take a look at term assurance, and we will be answering questions such as what is it, how do you set it up, what access is available, and how is it taxed?
So I'll kick off with the first question then, Helen. So can you tell us what term assurance is?
Certainly. So term assurance is the most basic form of life cover, offering a lump sum payment in exchange for a regular premium for a set number of years. If the person covered survives to the end of the term, there is nothing payable and the cover ends. There are a variety of different options in the marketplace, some offering a level cover throughout the term, some offering a decreasing cover, and others offering a monthly income benefit payable for a fixed term. The premiums are generally fixed at outset and are the same, so the same amount is payable over the term of the plan.
Why would you use a term assurance?
So term cover is generally the cheapest form of life cover, and it can be very useful in lots of different scenarios. So first off, for example, family protection, providing life cover for a couple with a young family to help finances on the death of one of them. It can be used for loan cover, so providing cover to repay loans on death, so mortgages or borrowing. It can also be used for IHT planning, providing short-term life cover to replace nil rate bands used up by gifts, so pets or CLTs. Or for IHT planning, there is a special plan called a gift inter vivos policy, which is used to cover the liability on a large pet where tax will be payable on the death of the donor. You also find if clients have got large estates and a large IHT liability on death, and they're perhaps not quite ready to do kind of long-term IHT planning, sometimes just putting a short-term measure in place, so a life policy for a fixed number of years, and that will give the client time to contemplate proper planning, and it could be a good option because it's better having some cover than not having anything at all. You also find the cover used by businesses. So for example, they might use what we call key man cover. So if they have got people that are key to the business, who if they died would be detrimental to the profits of the business, a fixed term assurance policy can provide funds to replace that key person. So as you can see, there are lots of reasons why term assurance cover is used.
Indeed. How would you go about setting up a term assurance plan, Helen?
So you can set up a policy on a single life basis, or you can set up a policy on a joint first death basis, which will pay out on the first individual to die. Generally, there's got to be insurable interest between the plan owner and the person who's covered by the plan. And the sum covered is usually the value of the loan if it's for mortgage cover. It will be the value of the inheritance tax, for example, for IHT cover. And if it's cover to cover off a mortgage or a loan, then again you would use the sum assured would be just the value of the outstanding debt that is due. If it's to cover a family member, so maybe like a young couple, generally it's a value which can be used to replace things like childcare, the running of the household on one of them dying. And in respect of key man cover, it needs to be enough to cover the cost of replacing the key person within the business.
All this cover doesn't come for free, so how are the premiums calculated on these policies?
So the person covered by the plan will be underwritten, and actuarial calculations are carried out to work out the probability of the client dying within the set term, and that would be based on their state of health when they take the plan out. So the more likely someone is of dying, the more the premiums will cost. And as there's no build-up of funds underlying term assurance plans, the premiums reflect the actual cost of mortality of the client, which gives us the cheapest form of life cover.
So in the event of a successful claim, who has access to the sum assured payable?
So Nick, the sum is payable on death and it's paid to the policy owner. So this means if it's a jointly owned policy, it will be paid to the surviving owner. If the policy was owned by an individual person who died, it will be paid to their estate, so their executors. And if it was set up on life of another, it will be paid to the surviving owner. Now, if the plan was written into trust, for example, then the proceeds will be payable to the trustees of the trust. And if it's owned by a company, the proceeds will be payable to the company.
And is there any tax payable?
So if this is personal cover, then there is no tax relief on the premiums, and therefore the sum paid out is free of tax to the policy owner. In respect of inheritance tax, it will fall into the estate of the plan owner unless the plan is written into trust. Now, when a company takes a plan out on the life of a key person, if they get tax relief on the premiums, usually the proceeds will be taxed as a non-trading receipt in the hands of the company.
That's great, Helen. So thank you. So to summarise, why do you think we need to know what term assurance is?
So the partners need to be aware of what is available for their clients to enable them to give the best options for their clients' particular needs. You need to help clients identify where there is a need or a shortfall in cover so that you can give them the best advice. Term assurance is the cheapest form of life cover, which will be useful for clients with young children, for clients who have a short-term need for life cover. So say clients who want to cover the large gifts for inheritance tax, for example. Sometimes, even when you've got wealthy clients who perhaps have not thought about IHT planning, you can still put a short-term plan in place until they've had time to think about their overall IHT strategy and want to do this in stages. So Nick, I hope that's helped you understand what is term assurance and that you found this wee short video useful.
Thank you, Helen. That's been brilliant.